To another session on a very important session. I'm going to talk about the financial projections. This module is named as accounting techniques for credit decision making. So how we use the accounting techniques for different techniques in accountancy for decision making, credit decision making. So this is very important in the business customers. When you deal with the business customers analysis, very important part is the financial analysis. Now you have already done the financial analysis part, the financial analysis and ratio. You have worked out the ratios, important ratios, what it says. You have to interpret that. Mostly in the examination, what we have found, most of the participant students, they do the analysis, financial analysis, they do all the ratios, they work out. But they are not interpreting the ratios, what it tells us, what it means. Each and every ratio gives some message to us. Now that message we use to make credit decisions. That message we have to interpret to the credit decisions. Therefore, it is very important, this part, financial projections. Okay, let me little tell about the how this process of the credit appraisal part, especially for business customers, credit appraisal. To analyze a credit proposal, what are the fundamentals? What are the basics? Now you may have gone through during this course different type of analysis types, that is 5 C's analysis. Then Michael Porter's 5 forces analysis. And sometime you may go through the sympatics, parts, Campari. All these are technical techniques for the analysis. When it comes to business analysis, the major 3 components are there to be analyzed. Right? 3 major components. First, you have to evaluate the customer analysis. Who is the customer and what is the background of the customer? How he is making decisions. Because any organization, any business organization, the success or failure mostly depend on the management analysis. Management analysis, that is the how the management behave, how the management taking decisions in the business. It will affect our recovery. The decision taken by the management, if it's not prudent, then it will affect our recovery. Finally, it's end up with the banks, our recovery. So therefore, this part is very important. So mostly what we do certain analysis based on the historical information. Let's see what are the information we do. So first part is customer analysis, customer background, the management concept, and his technical analysis. Management and technical, with the technical know-how. These are components of first customer analysis. Second one is business analysis. What is the business? What is the position of the business? How the performance of the business? And the performance of business, we reflect certain in the data. So the performance analysis or the business analysis, there are 2 components. Business analysis, 2 components. One is financial analysis. Second, external environment analysis. Right? These 2 are most important. Mostly what we do, the first part we do in our proposals in the banks. We do this financial analysis with us. But second part, the environmental analysis, we have neglected. That's mostly what happens with a proposal when you go to higher management for approval. It comes back, returned back by the information are not sufficient to take a decision. So you have to submit information to the approving authority in a manner which is convince the management about the proposal. That is our weakness. Most of the bankers or financials, when you're sending a proposal to high management, it has to be convinced the management about your proposal and it is the viability of the proposal. And it is a very broad area we have to cover up. Financial part, not only financial part, even the other part, environment part. So the financial part, we do the financial analysis ratios and interpret the ratios. What it tells us. What the ratio tells us. Sometimes last session you may have gone through this. Some of the ratios may have touched upon the ratios. But when it comes to lending to business, specifically corporate lending, high business lending, the interpretation should go into the in-depth, not on the surface of it. Right? So most of the things, what is the interpretation what we give? This is increase, this is decrease, that's all. Profit has been increased, net profit has decreased. Why it has increased? No answer. So in your proposal, when you send it to high management, you have to convince the management what the reason for declining the net profit. Where the profit is there, gross profit is there, right? That means the business is viable. For example, gross profit margin is say 40%, 45%. That means that business is viable. It's profitable. But when it comes to net profit, it is 5% or 10%. So 30% or 35% gone for the expenses, the P&L. Now there are certain costs are manageable, certain costs are unmanageable. This is where I highlight the management quality, how they manage the finance. Okay, so that's what we have analyzed in our proposal. Why the reason this has been declared? What are the areas we are declared? So we'll go into the details to find out how to interpret a ratio. That's our next session. Interpret a ratio and we'll apply the ratios into the details. Okay, now that is the first part of business analysis. Second part is environmental analysis. Environmental analysis, the most important part is the market analysis. Market viability. To recover, to become our loan, to recover, there should be sales. The turnover. The turnover, whether it can be achieved. What is the market position? So you have to do a thorough market analysis. You may have learned this. Michael Porter's 5 forces analysis. What are the affecting through the Michael Porter's and the affecting areas for market decisions, market conditions. And Boston metrics, you have sometimes done that, Boston metrics. Hands-off metrics, these are some of the techniques introduced to analyze this market condition. Market share, market condition, how the market behave. Secondly, the environmental factors, fiscal analysis, political, economical, social, technology, environment, and legal. 6 basic areas which is affecting a business. The political decisions, you may have come across these days. Social problem, okay, say COVID-19, how it is affecting the business. In technology changes, how this technology affecting the business. Technical enhancement, the legal changes, the legal changing the legal pattern, legal system, new laws have been introduced. Right? So those are external factors which is affecting the business. So when you do once you are doing a projection, you have to take into consideration both factors, financial factors as well as non-financial factors, market and environment. Okay, that is the second component of our business analysis. Third component of our business analysis is the collateral analysis. What is the collateral? The collateral should match to the risk. We are taking a collateral to cover to or mitigate the risk arising in a project. Because we know that we are granting a facility to recover unknown, uncertain future. It is unknown and uncertain future. Therefore, it is risk. That's a risk we are taking. We don't know. We can't predict what could happen the next moment. Sometimes certain things can be predicted. Certain information based on the information. Sometimes the information is not sufficient to take that decision. So therefore, the collateral analysis is very important. What type of a collateral you are taking? What is the type of a collateral? In the collateral analysis, there are several steps we have to follow. The several steps are: first, nature of the collateral, ownership of the collateral, to whom it belongs to legally, right? Ownership, then the valuation, how much is value, then the documentation part, registration part, stamp duty payment, right? So these are the steps involved in the decision, taking a decision on the collateral. What type of a collateral suit for the loan facility? So this is basically, before I start my financial part, basically we have to understand how we should do analysis. The financial, not only financial, credit proposal, there are vast areas to be analyzed before we take a decision whether to grant the facility or not. Right? Now, this is sometimes you may consider this as a time-consuming matter. Yes, it is sometimes time-consuming. Why it is time-consuming? Because informations are not available, or information are not readily on the desktop is not available. We have to find out. I will go into details. Depending on the volume of the credit facility, your analysis should go into more and more depth. More and more depth analysis needed. Otherwise, we'll end up with disasters. Okay, having telling that part, so let's start our what is projections, projection, and what we will going to discuss about projections. Now you have done the accounting part. Accounting part you have done. There are few steps in the accounting scenario. Accounting. First part is the recording the transaction. Day-to-day transaction, which is recorded in a set of books called ledgers. That's we call ledger entries. Without taking into consideration the period or the type of transaction, all the transaction, day-to-day transaction, in the ledger. That's the job of the accountant, technician, or the bookkeeper. So the first person is handling the accounts is just transaction are entered in the double entry system, that is giver and receiver. We put debit and credit. Right? Once you enter transaction both sides, at a given date, if you add together, it should balance. So we say it's a trial balance. We call this as a trial balance. Trial balance, debit and credit should balance. It does not give the accuracy of your what you call recording. It doesn't give the transaction the accuracy of that, right? But whether your transaction has been entered or not, sometimes you may, if you complete one transaction neglected, it does not appear in the financials, and it doesn't appear in the financials. Therefore, decision may be sometimes made go wrong. Right. The second component is the once it is prepared by the trial balance, the financial accountant take over those transactions. The ledgers, he go through the financial. What he does, he try to locate the transaction for the particular year. Now, normally we use the calendar year, 12 months, for a period to assess the performance of a business. Right? Now you have learned about the concept of accounting concept. So business is a going concern concept. It will not stop. Right? So we have techniques to calculate certain methods by accountants, and find out what is the actual position of the particular period. Therefore, what is not related to that year will be removed out. Right? What is not related to that year, previous year, or future payment will be removed out. And what is not, transactions are not entered, accruals will be added. And finally prepare what is the net result of the business. Net result of the business. And you do accounts, you may find that trial balance is given and certain adjustment entries are given. What are these adjustment entries? Transactions which not related to the period. So you adjust that. Right? Then comes the third step. That step, once it prepare the financials by the financial accountant, what are statement, and profit and loss account, and the balance sheet basically. If it's a manufacturing organization, manufacturing account. And if it's a public company, the cash flow statement. So these statements are prepared by the financial accountant. And then comes another person called management accountant. What is his role? Now here to justify the transactions. The management accountant will justify the transaction, whether this profit has been or the profit has been earned, justified, whether sufficient or not. Compare with the other businesses, similar businesses. Analyze the past trend, which direction the business is moving, and predict for the future. If that direction goes which way, and predict for the future, and future direction is prepared, called budgeting. That part is done by the management accountant. Then there are two more supplementary accountants. One is called cost accountant. The cost accountant's role is to calculate the cost for a given date. Now we discussed earlier, business is a going concern concept. It will never stop. To work out the profits of or the results of a business, we cannot wait till the business is over. Therefore, certain techniques are used to do that. Right? Now, for example, with the airline industry, of course, for the last these days you will find that most of the airlines they are suspended, their flights were down. That situation cannot be do for every time. Certain time only it has happened. It's an unexpected situation. Normally, you cannot stop the business to work out and find out. So when the cost accountant will calculate and say, going concern concept, at this particular point of time, this is the position of the business. This is the position of the business. And the other one is auditor. The auditor will go through the entire accounts and find out whether it has been prepared according to the standard regulations. Audit regulation, the company's policies, and justify transactions. Any adverse position, he will highlight. Any strength they are there, he will highlight. So all these things are done by an auditor. Now we are playing a role, bankers, out of the 5 subjects, we are playing a role of an accountant. That is, we are management accountants. We use the information given by the customer for our decision making. We forecast the profits, we work out for the future position, depend based on the past, we do the predictions. All these things are done as management accountants. So the management accounts we need to look at is current, more detailed accounts. What we get from the customer is published account. It's called published account. This, according to the Companies Act, there are 10 information should be disclosed, compulsory. 10 information should be disclosed compulsory. So when the financials prepared by the accountants only include those 10 items. Right? Others are just hidden. Management account is more detailed, comprehensive information. Management accounts are prepared at any organization, but it is not published. The published account for the public. The management accounts only for the internal use, financial, the management team. So as a bank, we need these management accounts to go into detail breakdown of the transactions. Okay, so to forecast the profit and to evaluate to justify the transaction, what is the position? When we look at this management accounts, we call this is very current and should be supplied regularly. What is the accounts? Now, for example, we ask for the customer to give us the financial statements. Now we are in August, sometimes some of the customers still not prepared their financial as of 31st of March. Still not prepared. Still we are waiting for that. They may give a number of reasons. But we have to understand one thing. We have to understand one thing. What is that? It is not difficult to prepare final accounts if the accounts are properly prepared. It is not properly prepared, then only the account will find difficulty to match each transaction and get a final one. The second problem is, so therefore always one problem is therefore the account, what the information what you are getting, the financial statement what you are getting is sometimes fabricated. Most of the instances is fabricated on the actual position. So we have a duty to evaluate and see, go into detail, visit the customer, and to justify whether that information are acceptable or justifiable. That's what we have to do. Right? I give an example case. I had one of my friends as a chartered accountant. So I asked him for him, why we are taking so long to prepare financial statement of customer. So we are also finding difficult to approve a facility for these people because the financials are not available already. What's the position? So he said, we will tell Majan. We have to match the sales with the BTT payments. We have to match the sales with the bank deposits. And we have to match with the purchases. Furthermore, my client says to reduce the profit, so we have to do that also. To do all these things, we have to prepare a fresh set of books. Fresh set of books to be prepared. So, ultimately, what we are getting is a fabricated one, no? Not an actual one. So, what you can do is you just visit, when you go for visit, very important visit to the customer's business, you can observe what type of a business, what type of volume of business, whether it's tally with your what the statement given. So that's our role, we have to pay when you go for inspections. The other thing is management accounts are current. We need the latest position. Because financial what you are getting, for example, is the 31st of March to 2020. Statement you are getting, that is the latest current position for you. But the information contained in that statement is for the year 2019. They already 1 year lapsed. It is historical and obsolete. Those information obsolete. It will give just only some information about the past performance. It will never give anything about the future. So therefore, it is very important for us to understand what type of a statement we are going to analyze. Right? It says in the accountancy, right? It is like a driving a vehicle. When you take this, driving a vehicle. A vehicle you find minimum of 3 mirrors, 2 side mirrors, rear mirror, and a large windscreen. What is the purpose of this? When you drive, you fall into pothole. you just jerk something. So you meet the driver, immediately look at the rear mirror and see what has happened in the past. What has happened in the past? Why I fall inside that? Why did I see that? What happened to me? Do an analysis, quick analysis to prevent in the future incurring that type of a thing. So how to avoid and go? That decision is taken. Similarly, when I do the credit analysis, we use the historical information. Those are past. Already happened. Only it will be a guideline to avoid such instances, incident, to avoid a go future, to plan out. The second, two side mirrors, what they use? Take the left hand one. Right? So to see whether any person close by to you, any motorcyclist or a push cyclist or a pedestrian that was that, who is close to you. On the right hand side, who is trying to overtake you. Whether we can allow him to go overtake, or what is whether his road is clear, or am I going, what is his speed, what is my speed, how can we do that? That's the current, exactly what's happening now. So the business also we have to analyze what is happening now present. Who are the competitors, try to override this custom? Who are the obstacles on the left hand side? Pedestrians, motorcyclists, try to cross. Right? The three-wheel car with bumming and low take and another. Right? That's a risk. So we have to have an analysis, our financial analysis for a business customer, for a make a decision. What type of risk involved on the inside? Any competitor try to override this custom, or any other regulatory barriers are coming? That is current. Next, what's the use of the large windscreen? To see forward, look forward. You have a rear mirror, side mirrors, you make a judgment and look forward, because our lending is for future, recover in the future. So therefore, you always look for the future. That's why the large windscreen is there for us. Right. Now what we do at the moment is we are driving the vehicle looking at the rear mirror. Even here. So ultimately what happened? We will knock somewhere and crash it. Most of the business failure because we are responsible. Our lending fails because we have not evaluated the position correctly. So the management account analysis is very, very vital. Right? So let us look at the lending proposition with what is the risk and what type of a security we have to take. And what type of a receipt, cash, and what is the profit. So these two are very important for our recovery. The profit will not pay back the loan. It is the net receipt or net cash. So we are going to discuss this in the future. And the assessment of going concern, business is to continue for indefinite period. That's a business, any business starts or run for indefinite period. But halfway they collapse. 25 years, 50 years, maybe within 100 years. Very rare business goes more than 100 years. So it is the business strategy. What is the business strategy? To continue the business. To bankers to deal with this customer for continuously. They have to analyze their strategies in the going concern assessment. Well, what is balance sheet? I just mentioned that. Even reason one is out of date. It's expired. It is obsolete. Latest on 31st of March 2020 is information appears for previous year. Therefore, already it is expired, out of date. Probably most balance sheet accounts change value daily. Customer business is a going concern. and it changes every time. Right? That's another nice proverb for this. Can you bathe in the same river twice? එකම ගඟේ දෙපාරක් නාන්න පුළුවන්ද? එකම ගඟේ දෙපාරක් නාන්න බෑනේ. Because you bathe and come out from the bath for applying soap and getting back to the water. That water is not the water you have been bathing in earlier. It has been already flown down. So business is also that. It's changing every day. It's changing every day. Right? So you have to understand that within the changing, depending on the environment factors, right? Business decisions, competitive behavior, that's why environmental is very important. Business is changing. Value may be changing, it may be increase or decrease. So we have to work it out in such a way. The profit and loss is historical revenues, historical statement, margin, historical cost. What has happened in the past? It's historical. What's a guarantee? The same will be incurred in this year. For example, you take the expenditures in the profit and loss account. What is a guarantee? I can assure the same figures will appear in this year also. Because of inflation, cost may arise, cost may increase. Due to other factors, changes, cost may increase. Therefore, it is historical. It will give some guideline for us to prepare future. Okay? These are only 2 chapters of a book with many chapters. So we have to understand that only a very small area, these 2 statements. The basic term credit assessment is looking at the past is only useful for what can it tell us about the future. It is a guidance. It's a guidance for us. We make lending decision today based on our expectation of borrower performance in the future. What will be the future performance of the borrower? Right? Lending decision today based on our expectation of borrower performance, how customer will perform next month, next year, next 3 months, 3 years during our loan period. Right? So based on the past information, present strategies, and future plans, add together, we put forward as a our lending decision. Another basic trend is the only thing we ever know for sure about projection is that they are wrong. We cannot predict future exactly correctly, very difficult. Sometime you have seen in the last few months, how many astrologists were predicting about the election and other things? Most of them went wrong, no? So it is not easy. So we also, like astrologists, try to do something which is never going to be correct, right? Because the factors affecting on the environment, external, are very strong. But there's a value in providing realistic forecast of activity and impact of the transaction under consideration. Therefore, but we cannot avoid, we had to do something to do a justification for that and make a judgment for the future performance of the customer based on the past. It will always change. It will not be correct always. And being confident about why. So therefore, always ask the question, why? Why has happened? Always look at actual performance versus what forecasted indicated. The difference is why. This is what we do every quarterly budget customers information we get, and we compare with our predictions, our projections, and see whether it is to attack is close to that prediction. Actually, is how close to our predictions. That's what we are always doing, no? If it's a different, stops at that. We predicted a profit of, say, for example, we projected the profit of 25%, but in the end of that next year, when you do the actual position, is only 18%. So can we stop at that? The customer performed and earned 18% profit. Last year it was 24%, and the customer has declined. No, we can't stop that. We had to ask the question why. Why it has declined? Or if vice versa, we predict 18%, but the customer achieved 25%. Why? That question we had asked. Achieved or surpasses? We had asked the question why. So these 6 things are very important. What has happened? How it has happened? Where it has happened? Why it has happened? When was it happened? Who is responsible for that? This is interpretation. In financial interpretation, you have to find answer for this: what, how, where, why, when, who. That's interpretation. Okay, so let's learn how to do that part. Okay. Why projections are important? That they indicate what must happen or not happen in order to borrow to be able to repay. Our forecast is always with the customer having the sufficient cash to pay the loan installment in the future. To which what should happen or what should not happen. What must happen or not happen. What should happen, we have to monitor and see whether it is happening. What should not happen, we have to avoid and prevent it when you do projections. Okay. They indicate how sensitive repayment capacities various possible changes. This is another important factor, sensitivity to change. Normally, when you do analysis, we do 3 levels of sensitive analysis. If the profit is, say, 20%, what is the position of the outcome? If the profit is declining for 18%, then what is the sensitive position? It is increased to 25%. What is the position? So this is called sensitivity analysis. It can be applied for any factor. What is the sensitivity for repayment of the customer? What will affect the customer? Okay, now taking the case. When we got a facility in the last regime, like 2015, 2016, there's a new scheme introduced by the last government. So the bank came forward to lend under that first 11 schemes. But some banks very positively looked in the future. They were waiting for the election. If the election changes, all these projections, this system may get changed. So it has happened. That's how sensitivity of a banker. What could happen next? Now we have political situation stabilized up to some extent. We hope that it will not change. For the next 5 years, the government will go as it is. So next 5 years, if it's going as strongly, we can end for 5 years without any worry because the political stability is there. The political stability is there, economical stability automatically comes. But we cannot say what are the external factors effect on that. External factors effect on the political analysis. So we have to be alert when we're granting a facility, what could happen in the future. So always have alternatives, that's called sensitivity. They can provide a basis of setting terms and conditions. So if you have to do a sensitivity analysis, we can make conditions to the customer. What if it is changed to this position? What if this position changed to this position? So we make conditions in advance for the customer to fulfill. So we are ready to face for it. That's why the importance of projections. They indicate how much cushion the borrower is like to have to forward monitoring. How much of cushion customer having in between any adjustment in the changes. So the sensitivity is very important because of that. We always not fixed to one figure or one what do you call a decision. It is the different scenarios how the customer should be performed and what should be the result. So we monitor that. If any changes take place, we monitor whether the customer is acting according to what we discussed earlier and according to our terms and conditions. Very important. Right. So we look at the cash flow projections, very important. We'll do later next week with cash flow. It is the theory part. Look at the past as a guide for future. Right. Past as a guide for future. What has happened, expenditure pattern, everything, we assume certain percentage, 10% may increase, or 16 to 20% may increase, or new business could take place and it will at a certain amount of expenditure, and adjust the plans and strategies accordingly. Right? Look at the past, adjust the management plan for future strategies. What is management trying to do next year or next 3 years? And adjust the data accordingly. Plan it. Adjust for industry, economic, and other development. These are external environment. Economic changes, industry changes, political changes, social, likewise. What are the changes you can anticipate? You make changes for that. And sensitivity, what if? I always discuss what if. What if this not happen? What will next? We assume the industry to be firm, but if something happened in the industry, what if? What if? What the next alternative? So we should have all said, when you do planning for lending, always see the sensitivity. What if this things changes? What the next option we available? That would be put as a condition. What we want to know is the company like to be able to continue to meet the obligation, and what we do monitor to spot the early warning signs of problems. It's a very, very important part. But we need to monitor to spot early warning signals. Right? So monitor continuously. We'll discuss this is another subject we have to talk about. Monitoring, supervision, follow-up, identify warning symptoms, identify the problems. This comes to the last module we discuss. Okay, so what we are trying to analyze in the credit appraisal is whether this company likely to be able to continue to meet this obligation with any changes taking place in external environment. What if? Okay, so what are financial projections? These are estimates of the future flow of funds. We do estimation for the future flow of funds, inflows, outflows. Financial projection is an arithmetic result of the group of previously decided assumptions or forecasts. Projection is a result of the group of previously decided assumptions. Previously do certain assumptions to do calculations. And for example, sales volume will be the past trend analysis we see. So sales are increasing gradually per annum. It is 10 to 15% growth is there. Okay, we assume that next year also 12% growth is there. You are now granting a facility, yes. With the giving this facility to the customer, when we improve the businesses, this may go up to 15%. That's assumption. So you have to see on monitoring whether the customer achieved that and why the reason if you are not achieved. If you exceed that, for that also you have to find reason. Why you exceeded? What went wrong? Our prediction. Our assumption may wrong. Why our assumption went wrong? So correct assumptions. It's an ongoing process. Okay. Now this is what the forecasting is a prediction of future events and their quantification of the planning process, defined by SIMA terminology. What SIMA had defined as what is forecasting is a prediction for future event. Look for the future and their quantification for planning purpose. Quantified. Qualitative statements are cannot be perfect because should be quantified. Quantify, then only you can plan and manage. What amount, quantum, that's important. Three essential elements are required before one can begin prepare projected financial statement. We do a projected financial statement for each period. The important factors are forecast sales. That is the main basis. Forecast the sales. What would be the sales? Then forecast the cost and expenditure. How much of cost to be incurred? We got the past information. See what are the changes going to take place. What is the impact on that change and what will impact to the cost. You can forecast for the future. Forecast for the required investment in net assets to achieve these sales. What amount of assets needed to achieve these sales? Now, when you talk about the net assets, most important part is the working capital, current assets, debtors, inventory, and cash. So, required investment in the working capital is very important. That has to be forecast correctly, projected carefully. Okay. The forecast is an assumption of what will happen in the future. What will happen in the future is forecasting. Now you may see sometimes you find some clouds are coming up and get a little dark on the environment. When you want to go out, what you do? You tend to bring umbrella, no? That's your readiness to mean that you forecast it will rain. Sometimes it may rain, no? If it's heavy blowings, the rain may go off sometimes. May or may not rain. So always forecast are predictions. It may happen or may not happen. Right? So you be mostly we are in positive manner. If it's happened, what are you going to do? You are already prepared. If it has happened, you are going to act in this manner. Forecasts are based on the analysis of past trend and the estimate of future development of the business internally and externally. This is what we are talking about all this time. Past trend will be continued as it is. Past trend to be continued for next few years, then that particular external environment should be constant. Should not be changed. But this never happens. External environment, business, internal, externally, always changing. Therefore, estimates, the loss has to be changed accordingly. That's why you do monitoring quarterly to see which direction is going, whether it's permanent or temporary. Temporary, you allow it as it is, till it comes okay. It's permanent, you adjust a forecast. Okay? Right. So, what are the factors affecting the sales? When you do sales forecasting, what are influencing factors for forecasting sales? Past sales volume and the mix. Right? Sales volume, how much of items sold last year? How many kilograms of items sold? And what is the mix of the sales products? What is the mix? What mix means how many products are manufactured or how many products are sold, types of products. Each product, what is the volume? and each product, how the business, the sales, affect into the sales. So that mix is very important. So sometimes you may find certain products in the mix pays very high return. Certain products may not give high return, it may give low return. But sometimes you may find that the which is given low return have a high volume of sales. High volume of sales. So therefore, if the margin is low, return is low, when the volume increases, sales automatically increases and profit also increases. Okay, it is not the matter for high profit margin. It is the volume of business. Okay, so for example, if you look at the grocery, grocery, their profit margin is very small. Margin is small. So by the volume, increasing the volume only, they earn profits. Turnover. It's called turnover. Right? So the mix is also important. There are certain products you need to meet the other products. Right? Product take a low profit margin in items, right? Profit margin low sales volume items, but it needed to help to other product to be so. Business. Okay. The second one is quality of the product or service. The quality. Today, most of the consumers, they look for the quality. Quality, if it's a physical product, is a quality. Service product, service quality. How they deliver the product. Right? So it has a big impact on the business. The strength of the brand name. This is another what they call marketing strategy by the business people. They try to build up a brand name. Right? When the brand name is very strong, sometimes consumers may tend to pay high value for the brand name. I give a small example for you to understand this. Very important. Now you go to Hamidia's, right? Look at a shirt. What's the price? 3,500. Right? So just see sometime on the shirt bottom, sometime you may find there's a tag. Right? Material made in Japan. Material made in Japan. So price is 3,500. That's a brand. That's a brand. We say GB or Enron. Sorry, the different brands are there. No? You go to another shop, for example, you go to Signature. Same material is available there also. You take a shirt and see, the same tag is there. But the shirt is 1,000 rupees less than the Hamidia's. And the same material. There the tag there, material made in Japan. Now why you pay more? Because your mentality has been created by the marketeers for the brand name. Kiripiti ඔක්කොම එකයි. නමුත් anchor එකම හොඳ එක. Brand name. So it will some sort of directing the consumers. So when the brand name is very strong, we predict the sales are, the value is very high, and the profit margin is very high. Okay, this is planned advertising expenditure. This is another important factor. To what extent the expenditure will pay back or improve the sales. What is the advertisement pattern? Now, sometimes you may find TV, radio, advertisement. TV advertisement, radio. And that particular channel is listened by island wide. Everybody in the country is listening. A particular business is established in certain place in Colombo. So advertisement in the country. This is what. If customers in that area, looking over the open lake, radio advertisement. So open lake, thin maragaman, but they advertisement in the radio channels and the TV channels. So look by entire country. Now, who are the customers going to come into look able to buy this thing? So that expenditure is right, not productive. So and identify, select what type of a plan advertising campaign you're going to take place, which market they are going to address, whether that the advertisement is going to that particular market. Okay, so these are affecting the sales. Then the pricing policy, right? Pricing policy of the customer, it is affecting the sales. When it affects the sales, it will affect our recoveries. Take an example. Most of them you may find certain products. They are reducing the price. They are reducing the price. Pricing policy, they reduce the price. When they reduce the price, well, sales proceeds are reducing, so it will affect our profitability, the profit and our recovery. But sometimes you may find that profit margin within that range, they can do a change. Right? Now look at you might go to shoes. You want to buy a shoe. You go to a famous shoe shops. You go somewhere, you got famous shoe producers. You may find most of the shoes are imported from China. The Chinese shoes are imported. How much the price? 3,500, 4,000, 4,500. You go to Malvatta Road, Meta. You find the same shoe at the rate of 1,500 or 2,000 rupees. See the pricing policy. So it is having effect on the sales. Next one is the capacity of sale. With the capacity can be absorbed by the business. For example, you predict for a customer, sales has to be increased by 25%. Okay. To increase by 25% sales, how much of the what you call cost of goods sold cost has to be increased? If the customer has the capacity to increase, storing capacity, financial capacity, you have to look into that and do projections. අපි ලොකු ගුඩුවක් හදන වෙසක් එකට ලොකු නතර ගිය ඇතුලේ නමුත් දොරෙන් ගන්න වැඩි දිනේ දොරක් තියෙන්නේ capacity එක මදි, so it's going waste. Something similar that. Then if any business having what you call a good reputation, supply is delaying, then advance bookings are important. Advance booking means customers are booking in advance products. So that also affecting the sales. The level of competition. Level of competition, how the competitors' behavior. Competitors' behavior. Right? This is very difficult to calculate, but you may be able to observe what is the competitors' behavior. Some are competitive with the price, some are competitive with the some other promotional activities. Right? Then consumer behavior. But consumers' purchasing power, how he buys the product, and what is his behavior. What are the factors affecting his behavior? That has to be identified by us. Finally comes external activities, state of the economy. If you're having a growing economy, we can see that most of the businesses are growing. In the past 1 year, you will observe economy was not growing. Most of the businesses were stagnating or could not move. Most of the businesses could not service our loan facilities. Our NPA has been increased last year. Generally, each and every bank, they have faced for these difficulties. To improve a business environment, the economy must be strong and moving forward. So the political stability also part of the economic stability. And the industry outlook. How that industry behavior of the industry, whether the industry have a future performance, future movements. Or the industry is growing industry or a stagnating industry. Some industries you may find not moving properly. Taking the case of some of the products are no more in the market. No one is going to buy. Okay, so see the outlook, how is that? And local activities and events. These are seasonality and these are take both together. Local activities and events within that area. What are the activities going to play? For example, Candy Perahara. There's a local activity. So within that period, sales volume may increase on the businesses. April season in Norelia, right? Activities are increasing. Then church feast at certain church locations, events, that will increase the volume of sales. Those are not permanent, but sometimes you may find seasonal, right? So when you try to expand, for example, Norelia, right? Norelia in the season comes, a lot of lot of people are coming to Norelia, and the sales are increasing. Therefore, most of the time, the merchants, they stock to meet the demand for that activity. But after that, no one to buy. It happens. I don't know. You're right. What do you mean? Okay, right. Hello? Hello there? Can you hear me?
Yes.
No, you told me that here, then I would have increased the volume or change the blockade position. Because the mic and speakers are still very little away from me. That's not the position. Okay, right. Continue with that. We were talking about the how to predict the sales volume, and seasonality and local activities is affecting the sales. Make the demand analysis. What is the demand for the products? The demand demand analysis gives us the how much and what season. Whether there's a demand for the particular product, manufacturing product or selling product. If there's no demand, there's no sales. So we have analyzed the demand when you do projections. So these are the factors affecting the sales, how to project the sales. So sales forecasts, many other forecasts are based on sales. Prospective demand we discuss. Then supply forecast for industry as a whole. To meet that demand, whether supply chains are or suppliers are can to manage to supply to keep the industry going on. How do you grant a facility for an industry, for example? What is the raw material supply? What are the packing material? How seasonal it is? When it's readily available? Based on that, you calculate work out the required funds. Starting a loan, for example. Now we have heard about JIT management, Japanese technology. Just-in-time management is there's no stocks, there's no what you call inventory holdings, or manufactured items are not stored. It is on the move. Raw material inventories are collected, assembled, manufactured, put to the market. There's no what you call warehouses or station. So that is one type of management. If that type of management, their working capital need is very much low. They don't have the whole inventory. But some industries you may find inventory are imported raw material. So there's a time lag to import from one country and getting another import to the country. So therefore, it will affect the supply and the prospective demand cannot be met. So we have to see what is the supply method, what is the level of supply, stocks to be maintained. Overstocking will result for an overtrading situation. When it comes to overtrading, customer may be facing difficulties in working capital managing. So it has to prudently manage. Results of marketing forecast and expect the share of the market. Now the market share is one of the indications, but it is not always what you call market share increase or decrease. Has to be taken as a whole, not as a only the share. For example, if a customer say, I have a market share of 10%, right? But next year he may have the market share, it has come down to 8%. This year, last year it was 10%, this year 8% market share, for example. So now when we calculate and say, we may assume that customer's business has been declined. He has lost the market. It is not the true story. We look at the figures, absolute figures, you may see that sales has been increased. Sales has been increased by 12%. Although the market share has been declined by 8%. So what has happened? The market has expanded. The market has expanded and the share of the market to this particular customer has been reduced and it has been distributed in the other market. But sales volume has increased. So nothing wrong. So it may be sometimes mistelecast. We have to take into consideration that factor. In the product price forecast is important. Cost. Most of the businesses, when you calculate, the profit margin has been affected due to the financial cost. When they borrow loans, they work out for the financial cost. But when they go for temporary facilities, TODs, level, they want to consider about the cost factor. How much to pay? So it will affect the cost of the product and it will affect the sales volume. Right. Next one is forecasting the cost. There are three types of cost. They are fixed cost, variable cost, and semi-variable cost. Now, this cost structure is very, very important for us to calculate. For what you call, we'll do in the break-even analysis, the cost and the changes of the cost, how affecting the sales. A fixed cost is the cost which is not changing with the sales. Fixed cost is not changing with the sales. Variable cost is changing with the sales. Semi-variable cost may change or may not change. We'll take into consideration fixed cost. Now, rent payment, electricity cost, utility payment, salary expenses, those are fixed costs. It has no relation between the sales. Sales increase or decrease, the same amount has to be incurred. Therefore, it's called fixed cost. But the variable cost is changing with the sales. The cost of goods sold, purchases and cost of goods sold is a variable cost. Why? It always changes with the directly relationship related to the sales. When the sales are increasing, CGS cost will be increased. Right? Semi-variable costs are some cost. Sometimes it is changing, but nature of fixed cost is changing with the sales. Now, for example, financial cost, selling and distribution cost. Those are semi-variable cost. Okay, so work out calculating, projecting, this cost factor has to be taken into consideration. Right. Forecasting the balance sheet items. Carefully and forecast when you do projected balance sheet. Debtors tend to increase as sales increase. Right? When the sales are increasing, if there's a customer having a policy of selling to credit sales, then the debtors may also increase. With the volume of sales increase, debtors also may increase in the same ratio, but we have to see whether customer is maintaining the ratio within that norms without changing that. Then stocks are needed. More stocks are required to meet the increased demand. So this is very important. When the business is increasing, we are going to improve, the stock levels may increase. The more cash required to meet increased cost associated with the increase of sales. This is what I discussed. We discussed earlier, semi-variable cost. When the sales are increased, some of the cost also moves upward. The creditors, more credit required for the suppliers and purchasing is the line of sales. If the sales are increasing, purchases has to increase. If there are credit purchases, creditors also increase. Then accrued expenses. More accrued expenses occur as a result of increased overheads. If the customer is not settling the expenses immediately on cash basis, then the accrued expenses will increase. The finally, very important factor, be carefully handled, bank overdraft. The bank overdraft is frequently used to bridge any financing gaps caused by increasing the activity. Bank overdraft is a frequently used to bridge any financing gap. Take the word very important. Bridge any financing gaps. Right? Therefore, bank overdraft is not a source of finance. Bank overdraft is not a source of finance. It is temporary bridge a gap caused by increasing activity. Let us look at practically how it happens. Most of the time, our customers tend to depend on our bank overdraft, specifically temporary overdraft. Correct? Temporary overdraft. What is temporary overdraft? When a shortfall of financial needed for the customer to meet their check, they ask for a overdraft facility. Overdraft facilities mean give a small facility, increasing the current account balance to meet the checks. Now, what is temporary? The duration is very narrow. The maximum period banks will allow, depending on the bank manager's delegate authority, 30 days, or some banks for 14 days. When high management approves, it goes to 45 days or 60 days. That's depend. Right? Now, is it bridging the gap of financial? No. The gap created by the customer's financial difficulties to be filled within that 30 days. Then, of course, overdraft is the product can be accepted. But more of what you use overdraft as a permanently continuous facility. The risk is there's no collateral security to the overdraft. Okay, so therefore, when you are projecting balance sheet, this overdraft figure has to be taken as to bridging the gap, right, for temporary. Then the fixed assets, as a business expands, new fixed assets are required. Note that fixed asset will not increase the sales increase, but only as a business reaches a capacity required expansion. When a business is expanding, they don't need any fixed assets normally. Gradually, when a business is gradually expanding, fixed assets are not required. When the fixed assets are required means that means the capacity has to be expanded. Capacity has to be expanded. Now, for example, when a customer wants to expand the business, improve the business, a lot of new raw material has to be purchased. But if there's no space to keep the raw material or inventory, you have to buy another premises or expand the present premises. So then the fixed assets will be increasing. Otherwise, not necessary. To earn profits, increase the profit by increasing the business, the fixed assets has to be kept in the same size. Fixed cost should not be changed. Then the profit can be increased. Hence, there is a long-term relation between sales and the fixed asset requirement. It is not short-term nature. In long-term finance, when the fixed assets are expand, only loss as well long-term finance in form of equity or more likely long-term debt to increase. When the fixed assets are increasing, it has to be financed by a long-term financing mode by the equity, that is a shares, equity by the customer, that be capital given by the customer, or borrowing from the bank is a long-term borrowing, long-term finance, not a short-term finance. Right? So when the fixed asset expanding, it cannot be met with the temporary overdrafts. It should be long-term finance. Right. Uses of financial projection is a planning instrument. They form a foundation to planning process by identifying and quantifying the enterprise's physical requirement using money as a common denominator. Identify the requirements of the business. How much? Quantify it. Identify and quantify. Providing estimate of future inflows and outflows. When do projection, when you have to do future estimate. Inflows and outflows. When you see the inflows and outflows and net flows are taken into consideration, the net flow should be positive. When net flow is positive, surplus function is available for repayment. So the estimation is very important to correctly identify what are the inflows, what are the outflows. Otherwise, you may find at the end of the day, loan installment cannot be recovered. Now the projection has to be very carefully handled to identify the correct, to the close effect, correct position. Establishing performance objective as a guide to decision making. Right? Performance objectives, that means what to achieve. It is a guide for our decision making. It's a standard. Compare actual result with the planned objective. And compare the actual result with your projections. Evaluating management performance. It's an instrument to evaluate how best the management is working. If you do a projection, when the projections are projected financials are met by the customer, that is accepted the quality of the management. Assessing the flexibility and efficiency of the enterprise. To what extent any quick changes the business can be moved without any difficulty. This is very standard. Okay, what are the limitations in projections? Projections are useful guides for planning and control of enterprises' goals, but they are based on forecast of future inflows and outflows. Based on the forecast. Based on the forecast. Right? So they are good as assumptions. When the assumptions are okay, good, justifiable, then your projections can be justified. But actually, it will almost certainly be different from the projections. That's why we started with that. Find the reason why. That's important. Making projection is a simple process. It's an orderly and arithmetical way of presenting information. So projection is, what is projection? The simple process, orderly and arithmetical way of presenting information. Forecast is a difficult process. They are based on judgment about uncertain future conditions. You cannot predict the future conditions. It may change. So it's a difficult process. Right. When you look at future planning, forecasting, or what do you call financial projections, we call as financial projections from the bank's point of view. But customer's point of view, it is we call budget. Accountants call this as budget. Right? So the master budget have three components. The profit P&L, balance sheet, and the cash flow. Total loss account, balance sheet, and the cash flow. What is there in the P&L portion of the account? Right? It is the operating budget, sales, revenue, cost of sales, other expenses, other department expenses, fixed cost. Then capital budgets, what is capital expenditure? Purchasing of raw materials, stocks, debtors when they are related to sales, creditors related to purchases. These are capital items, capital expenditure. Right? We're going to break down project profit and loss account income statement includes all the revenues and expenses anticipated for the budget from a budget month under review. So if you prepare monthly budget, it has to be prepared monthly basis. Normally we do quarterly basis. Monthly is difficult. Therefore, we go for quarterly. Then the balance sheet is the projected balance sheet is a statement of expected position of the entity of the business at the end of budgeted month. It contains the expected monetary value of asset, liabilities, and capital at the end of the budget period. Right? The cash budget is also called as cash flow projection. It's about how much of cash need. Cash budgets are prepared in order to ensure that there will be sufficient cash in hand to cope adequately with budgeted activities. To do these activities, what amount of sales should be there? They must contain every type of cash inflow, monetary receipt, and every type of cash outflow, money paid. So inflow, outflow, net result is how much of surplus cash customer having. Surplus or a deficit. Okay. So budgeting is a planning position, planning of the future. It's essentially a financial plan for expected sales, income, cost, and other projects. So what we prepare budget for future for the customer to work out to find out when the customer having a surplus cash to pay the loan. It is viable. Okay. Purpose of budget, it's a working plan. It is the direction given for the business to how to operate the business. It's a working plan. Normally in the operating plan prepared, each and every unit has a budget of the customer. And the coordinated plan is called working plan. And it's a formal planning process. It's a regulated method of working for planning. It will coordinate the activities of the different units. If a business is having number of units, accounts department, legal department, sales department, then stores. Right? There's a coordination meeting among these within the institution that will be by our budgeting and the finance control. Right. Preparing a budget represent what the business is trying to achieve in the future, what is to be achieved, what the profit, basically what the profit for the future. The figures should be realistic, therefore, if the figures are not realistic, the answer will be not correct. Therefore, this sometimes may be mislead. This position sometimes may mislead us. Okay. When the figures are not realistic, figures are given, exaggerated figures are given. If you based on that, we will work out our lending position and the loan installment. But if it's not realistic, we cannot figure out loan installment. So therefore, we have to be very carefully evaluate and see when these figures are realistic. Starting point for budget is sales. Normally, there are different types of working on budget. We'll discuss that later. Basically, the sales are the starting point. Cost of sales and other costs can be estimated based on sales. So this is called distribution method. You work out and see, step by step going. To achieve the sales, how much of cost of goods sold needed, what type of expenses are there, then the final result is the net profit of the cost. Draft budget may revise if not satisfactory. So we discussed earlier also, it is not a permanent one. The draft budget or the projections are not permanent. If we quarterly review, if not satisfied, we have to make adjustment. Okay. Prepare cash flow to identify the credit requirement. Cash flow projection will give you for idea about the cash requirement. Cash inflow, cash outflow. When the cash outflow is more than inflow, what will happen? That's a deficit. If that deficit to meet that expenditure, outflow, we have to pump some money. That's a credit need. That's a credit requirement. Okay, estimated profit and loss account. What are changes in the sales, debtors, creditors, investment of loan, expected profit. And what is the most other important factor is projected debt service cover ratio and interest service cover ratio. What is debt service cover ratio? How much of profit generated and how many times covers the loan installment. It's called debt service cover ratio. Normal norm is it should be 2 to 1. That means profit should be 2 to 1 loan installments. So that gives a normal prudent situation for this service coverage. Interest service coverage is applied for the overdrafts. To service interest, how much of profit should be there? It also normally we accept 2 to 1. Okay. Right. So there are different tools we are using to analyze the financial statements. First one is horizontal or dynamic analysis. Horizontal or dynamic analysis. Second one is vertical or static analysis. Third one is financial ratio analysis. The third part is we have already done. Okay, so first we'll discuss these two. What is horizontal or dynamic analysis? The horizontal analysis is comparing 2 years or more the financial data, right? Concentrates on the trends, accounts in rupee value, and terms in percentage terms, and present in the comparative form, right? We'll see, for example, estimated profit and loss account, preparing on the past 10 method, that is horizontal method. Compare to continuously got 3 years information, we got it. Sales 2,180, 2019 225, 2020 is 280. Cost of sales 72, 95, 130. Then gross profit is 108, 130, 150. The establishment and administration expenses 40, 50, 60. Selling expenses 45, 65, and 90. Financial expenses are 5, 5, 5. It is not changing. Therefore, total expenses 90. And 2018, they earned a profit of 18. In 2019, earned a profit of 120. Sorry, 110. Total expenses 120. So profit has been declined 8.8. This is 18%. 2019, 10%. And 2020, the situation, sales has been increased to 180. Cost of sales have increased to 130. Gross profit also increased to 150. Right? The establishment expenses 50 to increase to 50 to 60. Selling expenses 65 to 90. Financial expenses remaining same. Total expenses 155. End up with incurring a loss of 5. Right? Now, using this information in the horizontal method, we have to predict for 2021 figures and calculate 2021 figures. Okay, right. Shall we work out this? Then tomorrow point board digga. Can you see the board? Board hai? Can you see the board?
No.
Hello?
Yes.
No? Okay.
Yes.
The thing is, when
Yes.
when you see the classroom, I used to do that in the
Yes.
board itself. But now today I had to write it off because it is not compatible. Right, I'll go to the board. Now, you've got 3 figures. 2018. Switch off your mic. Huh? Somebody has switched on the mic. Okay, thank you. 2019 and 2020. Projected figures for 2021. Sales 180, 225.
Can't see.
Can't see. Now? Now can you see?
No, sir. No. Can't see.
Okay. Okay. 225 and 280. Nothing to worry, scan this. Your handout is there. Same figures I'm going to put it on. CGS. I just enter the figures, right? 72, 95, and 130. In GP, gross profit, 108, 130, and 150. Administrative expenses, 40, 50, 60. 50, 60. The selling and distribution, 45, 65, and 90. Financial expenses, 5, 5, 5. Total into 90. Therefore, net profit is 18. $120. Net profit is 10. 155. Net loss is 5.
Hello?
Hello? Hello?
ඒක පොඩක් අර මේකට රෙසෙට්ටි අර සයිට් එකට ගිහිල්ලා නේ
ඇහෙන්න පොඩ්ඩක් කියනවා. I can.
මොනවද දාන්න 18ද අnder
Disturbance එකක් තියෙන ඇහෙන්න.
16 89 means doubles
60, 90.
මොකද කරන්න කියලා නේ
ඔය ෆිගර්ස් ඔක්කොම ඔයගොල්ලෝ මේ handout එකේ තියෙනවානේ. මේ ෆිගර්ස් handout එකේ තියෙනවා නේද?
Yes, sir.
බලන්න මෙයාගේ ඉන්න ගන්න.
අද දාන්නම් දැන් UPS එක නේ
Hello?
UPS නේ නේ අද විනාඩියක් ෆෝල්ඩ් එකේ ඉන්න
බෝඩ් එක පේන්නද? බෝඩ් එක පේන්නේ නැහැ පොඩ්ඩක් බලන්න.
hello
අපට ගින්න ලිමිට් වල විනාඩියකින්ද? දැන් පේනවද? දැන් බෝඩ් එක පේනවද?
ඔව් පේනවා සර්.
පේනවා.
සර්.
ඕකේ අපි එවනම් වර්ක්අවුට් කරමු. ෆිගර්ස් එක ඔයගොල්ලන්ගේ ස්ටේට්මන්ට් එකේ මේ හෑන්ඩ් එකේ තියෙනවා. හරි? දැන් අපි කරන්න තියෙන්නේ we have to work out the trend. Each year, what's the trend? What's the growth? 2018 to 2019, it has been increased by 45. Okay? So 45 Gatana over 180, that's a growth rate. Yeah, what is here? Oh, 25%. Yeah, 25%. 280, 225 to 280 growth rate is how much? Again, 55 over 225 is equal to 22.5. Sorry, 24.5. Growth rate is 20. The cost of goods sold, similarly, what's the growth rate? Uh, 23 over 72 into 100. Thirty-two percent. The 32%. 2020 growth figure 130 minus 95 increased by 35 37%. Gross profit, when is the 130 minus 108 divided by 108. 54%. Is 20%. Okay, administrative expenses. Increasing the 25%. It's 20%. 44%. 90 minus 55. 15%. Okay. Okay, what I did here, I work out the growth for 3 years, figures here given there. You take the growth figure. This 2009 growth is 25%, 2020 growth is 24%, right? And cost of goods sold increased by 32%, 37%, GP 20%, it is 15% decline. Administration is 25%, decline of 20%. Selling and distribution is 42% and 38%. Okay. Now we have to take the average of each growth rate. What is the average growth rate? Right? Average growth rate 24 and 25 and together divided by 2. So 24 point and something total we keep it as a 25 is the projected growth rate. The cost of goods sold is 37 and 32. 37 plus 32 divided by 2, that is 34.5. We can see it at 35. Very low figure. And gross profit margin, it is not necessary you can calculate the difference. Then 25, 20, 22.5, that is 22.5, you get 3 at 22, 23. And this also increases little high, 44 and 38 divided by 2, 80%. Right? Yes. It is increased by 41%. Right? Now, what I did here, we have worked out the growth rates for each item and then had the average growth rate, projected average, is average growth rate. Now we work out the projection for 2021, projected figure for 2021. To do the projections, we always take the last year as the base year. This is the base year, right? Always take the previous year as the base year and apply the projected rate into the base year, and that will give our projected figures. Okay, that's a procedure, how to calculate the projections. This is one method, is horizontal method. And horizontal method, how to account. Right. So 25% on 280, how much? Right? 25% growth on 280, how much? Either so this is as well 180. See this is by value. Okay. Again, never get it. 280 multiplied by 1.25. So that's 350,000. And the projected 2021 annual projected figure. Say so. Right. CGS here. 35% on 130. 130 into 175. In a GPA, may they give us a 175. Right. Administrative expenses increase to 22%, 16 what do you know? 1.22. 73. Selling and distribution expenses 41%, value you know 90 90 into 1.41. That is 187. We have enough sleeping. See. Our projections are minus 30. Minus 30. Okay. Figure see 100. Hello. Hello. Okay, hello. Yes. Yalakatino very. Right, shall we discuss about this? Hello?
Yes, I can hear.
Okay. Now, this is one method of doing the projections, right? Without any change. The structure will be same. But if you structure of the figures will be remaining same. Structure oh, and structure everything in there. ये basic उल्टमा predict करना मतलब growth rate apply करना. So it will not change. The pattern will be remaining same.
Hello, sir.
Yes.
Hello.
Yeah.
So the total of the net profit is 25, is it?
Which one? Here?
The calculated year we have calculated in 2021.
Yeah.
The net profit is 25, is it?
It's 30, no?
It's the difference of 175 and 200.
200. Yeah, 25. Okay, right. Minus 25.
Yes.
That's okay. So minus 25. That is our prediction. Now, normally, no one is going to predict for a loss, no? No one is going to predict for a loss. That is a normal position. But now, if you're going to apply the same method, that is a disadvantage. There are advantages as well as disadvantages. So advantages are it won't change. If the structure is firm, then these two figures will be realistic. But unfortunately, you may find one figure, it is not supply, but it was selling and distribution expenses. At the same rate, it will increase to 127. Now, if you look at the sales, that's not being increased at that level. Right? That's a disadvantage we can see applying this type of method. If any abnormal position, abnormal situation in one of the items, it will be reflected in the future also without any change. That's a disadvantage we are having. So advantages are, if the structure is strong, same, then it will be justifiable for us to take into consideration. So this is one method we use. It's called the horizontal method. In other words, we try to distribute the expenses in relation to the average trend. Okay. Right. The next method is horizontal method. Shall we have a tea and cup? Have a small break. The next one is the next method is called for financial projection is the vertical analysis, so the vertical method. Now, this is a very common size statement we normally call, because this is commonly used by most of the banks as well as the organizations. That reveals each item percentage item. That means each item in the balance sheet of the P&L going as a ratio, percentage to the sales. Right? So what percentage of sales, for example, for expenditure, what percentage of the sales that expenditure? Cost of goods, what percentage of the sales? Profit. Now, normally we work out profit, only profit, no? Now here, not only the profit, all each and every item, what the relationship to the sales, percentage wise, we work out. Right? Then thereafter we apply our projected figures and distribute down the line or the downward, depending on the ratios, depending on that particular ratios. Okay, that's called vertical analysis. It is so it's going. This analysis is very important because at any stage you can start do an analysis, not only sales, to work out the profit. For example, to earn such amount of profit, how much of money should be invested in the GP, gross profit? How much of sales can be achieved? If you have this much of sales, what would be the cost? Likewise, given any particular position, you can work out towards upward or downward. That's the importance in the vertical analysis. This is commonly used in most of the organizations, banks and financial institutions. It's a use the financial statement, apply the value given the base value. The material financial statement item used as a base value, and all accounts of financial statement are compared to it as a system. For example, vertical, for example, sales. Now, sales given as £990,000. So it normally we consider sales as 100%. Sales always 100. This is the base figure. Sales will be the base figure. Sales will be base figure. It is 100. Then cost of goods sold 574,000. Right? That means for 990, what percentage the cost of goods sold? That is 58%. Similarly, what is the gross profit? 416. Our different things 416. Percentage to the sales is 42%. You see, now if you add these two, it's telling the 100%. Right? Now 42% is the gross profit. From there onward, we are going down the line for other expenses. The selling expenses 130. 130 to the sales is 13%. 130 over 990 is 13.1%. General expenses 122,500 is equal to 12.4%. That is equal to, let's say, from the sales figure, it is 12.4%. Then, once you add these two, the total operating expenses 130, 122 is 450 to 500 equal to 25.5% of the total sales. The income for operation, 416 minus 252,500 equal to 163,500. Gross profit minus expenses is income from operations. 42 minus 25.5 is equal to 16.5. In other words, income from operation 163,500. It is, if you put it on the sales, it is 16.5%. So the interest expense is 24%. That is the sales 2.4%. In yeah. Okay, right. 162,500 minus 24,000, 139,500. That is 14%. That is income before income taxes of 14%. The income tax expense of 36,000 is 3.7. 14 minus 3.7 is 10.4. In other words, net income 103,140 over sales 990 is equal to 10.4%. So each and every item showed relation to the sales. What percentage from sales? Right? So that's how the vertical analysis calculate. It is easy for at a given point. From any point you can work out how much the sales, so how much the cost of sale, or what is the net profit. Any item you can work it out. Now, for example, we say net income is 10.4%. Then what would be the sales? You apply this into the net income, you will find sales. You can find sales. This 10.4 is equal to 103.4 into 100 is sales. Right? So, for example, if we apply, when you grant a facility to the customer, a loan, we expect customer to spend, use that funds for improvement of business. For example, so improvement of business means he had to purchase stocks, right? So if you're given a loan, the cost of goods sold will be increased by that amount, right? Now, if it's 58%, right, the amount is, for example, 1 million we are given, that is 58%. Then what is 100%? You can get the, after investing the cost of goods sold, how much of sales is increasing. Similarly, what is the gross profit? Okay, so it can be worked out either from top bottom or bottom upward. That's called the validity of this vertical analysis. Very important. Okay, shall we do a small exercise? Now, figures are given here. Sales 260, right? Because cost of sales 144. Therefore, gross profit is 116. I got a simple P&L to work out. Established expense of 31 million. Selling expense of 26 million. So, financial 5 million. Net profit is 54 million. If you work out percentage-wise, sales is, if your sales is 100, if the sales is 100, CGS is 55%. Gross profit is 45%. Then established expenses 12%. Selling expenses 10%. Financial expenses 2%. Net profit 21%. Now, if you add these figure, you get this gross profit here, right? Then you add cost of sales and these items, it will equal to 100 is equal to sales. Okay, right. Now this is the figures. Now let us work out for projections of 2021. What will be the projected figure for 2021? Now here we don't have a base of sales, right? We don't have like the earlier method, horizontal method, where we will use the trend. The horizontal method, we use the trend. Here, there's no trend. We have to take a statistical application. So, for example, Sometimes you may find customer may say sales will be increased by 25% based on the 2020. 2020 sales will be expected to increase by 20% or 25%. Or you can say we try to achieve a sales level of 350,000 or 400,000. Right? So if you apply that as a base figure, then what would be the what would be the net profit? That's called this, vertical method. Right? Now we'll work out. We'll assume it's an assumption. Sales figure will be always started with the assumption. What would be the assumed sales? You say, you want me to work out in the board? What do you work out in the board? Okay, board में बेरा है? बोर्ड में बेरा है? Sorry, 2020 sales 260, cost of goods sold 144, GP is 116, administrative expenses 31, 26, 5, net profit is 54. This is 100%, this is 55%, 45%, this is 12%, 10%, 2%, 21%. Okay, now let's work out for propose a projected 2021. Now we assume what will be the sales. We had to do assumption on that, right? We said projected sales, expected sales, this is 100 million. Projected sales 400 million. Then what could be the cost of goods sold? 55% of the sales. That is 400 into 55% is equal to 220. Okay? And 45% of the sales 400 is 180. And 12% on 400 is 48. 10% on the 400 is 40. 2% on the 40 is 8. This profit is projected profit is 84, equal to 21% of the sales. That is 400. $84,000. Very simple method, but this is practically applied. This method is practically applied for working out our calculations. Right? Now, last time example we had given, the customer is expected to increase the profit by, we say, 5 million or take 6 million. Then what will be the sales? Customer is investing money to the business, right? Then this figure will increase up to certain extent, and then what would be how much the sales, what would be the related expenses in relation to sales, and what would be the profit. So we can calculate one by one on that. Okay, it's called vertical method. Next method is, okay, now with me. The third method of working projections is strategical approach. We call strategical approach. Strategical approach means the management or the company wanted to do certain changes in their existing balance sheets and project the figure accordingly. What are their projections? 2021 sales based on the past trend. 2021 sales based on the past trend. Then expenditure based on the past trend. That is used on the trend basis. Gross profit should maintain at 50%. Gross profit should maintain at 50%. Decided not to spend on promotional activities. This will reduce selling expenses. In 2021, a strategical decision taken not to spend on the promotional activities. So, if now because of this decision of not spending, they can reduce the selling expenses by 20%. Now, we can apply this into our figures and try to work out. The information given is similar to the first one, horizontal method. Same figures are given. And we apply this information into the what you call strategic method and try to work out. Okay. Right. Sales based on the past trend. This is the basic are given 280, 130, 150. 55 and -5. This is the base figure. So from here we go using this strategic method. Now 2021 projected to 2021 sales should be depend on the past trend. So what was the past trend? We worked out earlier it is 25%. So therefore it would change 350 million. Huh? Boleh dah.
Presentation dah share. Kita nak dokumen. Ini harus stop sana.
Ada tu. Kami juga mahu.
Memang orang ini.
Kami juga. Kita pindah sih.
Nah, ini.
Huh?
Ini.
Right. Okay, now okay? Now okay? Okay. Now what is the strategy? The sales will be on the average trend. So we worked out the average trend is 25% on the first method. Same thing will be applied to another thing. Next class we say gross profit should be maintained at 50%. So GP will be 50%. Right? GP will be 50%. Okay? If GP 50, CG also 50. 50% on the sales. That is 175. The gross profit also 175. 50% of the sales. 50% of the sales. Right? 175. $60.95. Next item is administration expenses. Expenditure based on the past trend. So it will be the same as last time. It will be 73. It was 22.5%. Last time was that one. Then selling and distribution expenses will be reduced by 20%. Selling and distribution for 90, it will be reduced by 20%, 20% minus. Okay. Minus 20% means is 72. Then if I will be as it is, so what would be the profit in this method? 175 minus 73 minus 72 minus 5. Profit is 25. Okay. Now see the difference, the same figures we used had only small change. That is the change in the gross profit margin and change in the unproductive expenditure. That is selling and distribution expenditure. We saw that this when you work out the normal horizontal method, we apply the same trend. Right? Now without using the same trend, customer want to reduce the cost by 20%. New expenditure. Therefore, the expenses came down from 72, thereby therefore, 2020, there was a loss of 5 million. It has been converted into a profit of 25 million as a projection for next year. The slight change, the figures have been changed to a large extent. Okay. Heavily clear? Is it clear? Right. Okay. I assume that it's clear. So now this we discussed the financial projections, 3 methods applicable on basis of how to work out the projected financial figures by using 3 methods: horizontal method, vertical method, strategic changes method. Right. Next projection methodology we use is the ratios, financial ratios. What is a financial ratio? And what is the purpose of financial ratio? Now, this already you have done this part with the financial ratios. I'm not going to talk about details. What I am going to do is take those financial ratios, apply to certain information, and try to make a decision on that to find out the reason for change. Right? The result of the financial ratios will allow us to appraise the position of the business. Financial ratio will show absolute figures will not give any information. Absolute figures will not give any information. Informations are not, for example, if the customer comes and say, I have earned 1 million profit last year. What does it mean for you? Is it a good position or an acceptable position? We must compare with something else. Normally, we do comparison with the past trend. If we ask the customer, what was your last year's profit? It was 1.25 million. 1,025,000. So what has happened? It has increased or decreased? It has decreased. So it is important. Find out. It is increased by 25%. For customer comes say this year, last year I got only 1 million. This year 1.5 million. So it has been increased by 5 million. 5 million. That means increased by 50%. So that percentage is very important to identify. Whatever absolute figure, it will not give any picture for us. The picture is the ratio. Therefore, you can analyze one business company with another company. The volume of sales and volume of business may be changed, but the ratios will be standard. That's important. So it's the position of a business. Identify the trouble spots and need attention. Any negative or adverse ratios, you can identify the problems of that business. For example, you may find, last morning I mentioned about that, gross profit margin has increased, right? But net profit has decreased. So some problem there in the business. Identify the trouble spot where the problem is. Either it is in the administrative expenses, selling and distribution expenses, or financial expenses. What are the controllable areas? What are the uncontrollable areas? Right? Then, if there's a controllable, the change is coming from the controllable area, we advise the customer adjust this figure, or don't spend money on this one. Otherwise, we won't get credit. Why? Our money is then used for that particular trouble spot or the mismanagement. So we are not going to finance for the mismanagements. That's the importance of this ratio analysis for us. One of the importance. Make projections and forecasts about the course of future operations. So financial analysis ratios and past trends will give us some sort of direction to prepare future financial ratios. So what are these ratios? Liquidity ratios, asset utilization ratio, inventory ratio, solvency ratio, profitability ratio. One more ratio is not here. Liquid inventory, profitability. Activity ratios. Other ratio is activity ratio, the inventory and some more there. That, all they can put into one thing, those activity ratios. Okay. Now, I think we can't do that to financial ratios. After working the ratios, we'll do this exercise. This is the question I gave in November 2018, right? This is information given. Using these inventory ratios, how to you find out the information what you are given here. The required is you are required to prepare a projected income statement of the trader for next year. As a banker's policy not to entertain TODs, but term loan, short-term loan. So that the amount of short-term loan, how much you will propose to the customer, 10 marks. This was the question, 2018 November. So information gives us the sales, cost of goods sold, gross profit, administration established expenses, selling and distribution expenses, net profit. The trader has planned to expand his business next year, projected to increase the sales by 25%. Right? Sales, they have tried to expand by 25%. He is not planning to borrow his, and he intends to utilize the retained profit of the previous year for expansion. So he's not going to ask for any money, any loan from the bank for expansion. But he will request short-term finance, TOD, from the bank as and when needed. As and when needed, he will be asked for TODs to bridge that gap. He estimates cost of borrowing around 50,000 for the entire year. How much the cost of borrowing? That is the entire year. His projected figure is 50,000. The following additional information extracted from the financial ratios. Inventory holding days 30 days. Data collection period 15 days. Creditors payment period 10 days. Now this part you already done now? Have you done this part with the earlier lecturer? Or else after doing this part, you want to do this calculation? No idea. Okay. Therefore, then we'll stop at this one, at this level, and we'll go to the next slide in easy. Otherwise, I don't think it is prudent to do this calculation. Sometimes get confused to you. Are you aware of this ratios? Inventory holding days, data collection period, creditors payment period. These are activity ratios. Now we apply these activity ratios to calculate the investment, how much of investment needed for the business. Okay? How much of investment needed for the business. Shall I work out this? और खता करना है नहीं अरे अभी रेशियो स्टेप उल्टा बदला आप हो गया Right, I'll work out this in the board. In any difficulty, we'll discuss in the next session. So in the next session, I'll be talking about this. I'll go back to the interpretation of ratios. In that, we'll discuss in details about this one. Okay. Okay, अभी discuss करूँ method पाविच्ची करेला. We'll do the work out this case. Right. What this case says? First, you have got a structure: sales, cost of goods sold, GP, administrative expenses, selling and distribution expenses, and net profit. Okay, sales. $1.5 million. CGS 900. GP 600. Then administration 225. Selling and distribution expenses of 100. Net profit 275. This is information given to us. Right? Now we'll do the projections for future next year. The trader is planning to increase the sales by 25%. So sales will be increased by 25% next year. That's a projected figure. How much that figure? 1,500,000 into 25%, 1.25. That is 1,875. Right? Sales will be how much? What the cost of sales? What the percent relationship here? This is 60% of the sales, and this is 40% of the sales. And just now we have discussed this vertical method. So 60% of the 18, this amount is how much? It is 1,875. 60% of this 125. So 40%. Okay, administrative expenses are how much? 225 divided by 1,500 and 200. 15%. This is 15%. Six percent. So 15% of the sales is 1,875 into 0.15 is equal to 281. $281. 6%. So let us get by 6. And then okay, we'll stop at this point and we'll go for the other one. Right. So we have just distributed figures, how much sales and other things. He's next year increase the sales. He's not planning to borrow and intends to utilize the retained profit for the previous year for expansion. But right, so he will not take the money from the bank, and what he want to do is use his own the profits for expansion. Good idea. But he will request a short-term finance TOD from the bank, and when needed, as and when needed, he'll ask for TODs. He estimates cost of borrowing around 50,000. So cost of borrowing will be 50,000 financial cost. This is new one. Financial cost 50,000. Okay. This will be the figures. Right. So what would be the profit? 750 minus 281 minus 112 minus 50. The expected profit is 307. Right. Now the problem is he's asking some funds. How much of the first part is okay? You are requested to prepare the projected income statement for the trader next year. So he prepared the first part. That is 8 marks. The second part is the bank's policy is not to entertain TODs, but term loans, short-term loan. If so, what amount of short-term loan will you propose to the customer? How much he needs as loan, OD, how much of OD to be entered in the maximum limit we have to consider, right? So that will be, we are not giving an OD, we are giving only a short, we have to consider for only a short-term loan, how much of loan he needed. So that has to be calculated, right? We are using the other information. Right? What are other information? Inventory holding days 30. Data collection period 15. Creditors payment period 10. So what is the cash cycle? Cash cycle is 45 minus 10, 35. 35. Cash cycle is 35. Okay. Then what is the cash cycle turnover? That is 365 days divided by 35. That is 10 point. $10.4 days. The concept is, next time we analyze this one, beside this part, just look at this part. So this question is okay now? How comfortable? This is, we'll discuss. I think better we'll take the next session because we are discussing this one in the next session in detail. Anyway, I'll just put a ghost for you to understand what it is. Now, this is what the principal is. Now, this is annual. The figures are annual figures, right? Therefore, this annual figures means cumulative. There's a cost of goods sold is 1,125. To get this 1,225, how much he should invest in stocks? That's a we have to work out. How much he had to work out in the stock purchasing of stocks. So for which we had to work out invest the holding days. This is the concept we are using. Okay. Now, basically, in other words, the cash cycle or the cash cycle turnover is 10 times. It's 10 times before only this figure has arrived. This figure has arrived after spending 10 times. It goes 10 times. In other words, inventory holding 30 days, debtors 15 days, 45, and payment payment to previous 35, 10 days. So cash cycle is 35 days. To convert stock into cash, it takes 35 days. Right? Stock and debtors, the entire cash cycle takes 35 days.
You touch her.
Hmm? Hmm?
Sir, these are
Huh?
Correct.
Maybe Kalpati tape.
Correct.
Oh. Okay. Inventory holding days 30, data collection period 15, and creditors payment period 10. Now these are we have calculated during activity ratios. Right? So for a one cycle, it takes 35 days. Convert the cash, it takes entire cycle is 35 days. For a year, therefore, it is 10 times the cycle rotates. 365 divided by 35 is equal to 10 times 4 days. That means whenever we invest something on January till December, it rotates 10 times. Whatever investment will be in the business rotate 10 times. Stocks are purchased, sold, debtors are created, debtors are paid back the money, then again invest in the purchasing of stock, again debtors are creating, likewise it's a revolving. In the business, this is revolving. Right? Therefore, whenever we are going to invest money, that investment will be rotate 10 times in the business. How much you give, that amount will be rotated 10 times in the business, depending on the cycle. The cycle is expanded large. For example, expanded is, we say 5 times, then it will rotate only 5 times. That depending on the business may change. So how much you need to invest in this business? To expand this business, 25% sales, to achieve this 25% sales growth, how much has to be invested in the stocks? That's something I will calculate. So how much? It is 1,125 inventory, 1,125 million into, divided by 10.4. But this is accumulated 10 times. This annually accumulated figure is 10 times. Therefore, how much you need to give this customer is this much. Right? 1125 divided by 10. That is 108,000. So the maximum limit the customer needed for a time, at a given time is 108 billion. We take as all billions, 108 billion. Okay. If you invest 108 billion in this business, sales will be increased by 25%, and customer can earn 307 million of it. That's all. Right? So this is how we have to work out the important ratios used to make a credit decision. How much of finance to be given this customer to expand the business to achieve 25% of the sales. That's what we have calculated. What we used is structure of the cost and calculated the projected sales and the all expenses. Right? And it has been increased by rotation by 10 days. Another 10 times it will be rotated in the business. So, right? So every time you rotate, so we are not considered the profit invested back, only the capital amount invested. There are certain methods are there, we can work out in the profit loss if we put it back to the business, how much can be earned, right? That can be worked out. Okay. Right. So this is what I want to we want to discuss today. Financial projections. This is what we use certain methods, financial methods for calculating for projections, future projections. First we discussed the horizontal method. Then we, on the horizontal method, we work out on the trend analysis, what could be the expected figures for the future years. It can apply 1 year, 2 year, 3 year, depending on the period. Secondly, we discussed vertical analysis. So we use the vertical analysis for this particular exercise. We use this vertical analysis. In the vertical analysis, what we did, right? We distribute. We look at the relationship with the sales and other costs, and whenever we want to apply that back for expansion, we use that method to find out how much of this can be given. Okay. The same type of exercise given on the other slide. On the other side, I have given the similar type of exercise. It is vice versa, other way about. Now here, we are given the figures. We try to find out how much of investment to be made to this inventory to earn this, achieve this 25% sales, increase of sales, 25%. How much of to be invested? Right. The next slide, which I given to you, is there the other way about. If we invest certain amount in the business, what would be the profit? Similar method, same thing we apply. Now, but in that method, we are using from bottom to top, right? And here it's called bottom to top. There, what we try to do in the other case, this one. Okay, now let's look at this one. This case, sales 1 million, cost of goods sold 600,000, gross profit 400,000. Administrative expenses 100,000, selling and distribution 50,000, financial expenses 10,000. Total 160,000, net profit of 240,000. Fixed assets 250,000, stock inventory 60,000, debtors 80,000, total 180,000. Current liabilities, creditors 50,000, bank overdrafts 80,000, 130,000 total into. Therefore, working capital or net current assets 10,000. So 250 plus 10, 260 equal to equity is 260. Customer asking a loan of 300,000. They're offering at the rate of 18% per annum for 3 years. Right? So all expenses will be remaining same. Excess other than the selling expenses will increase by 10%. Work out the viability of this project. This proposal. Can you do it? What we did the same thing we did on the other case, same thing. Okay, so how to do the projection of the profits? Can you do it alone? අන්තිමට එන මම කරවනවා. ගෙදර කරනවා නැති කියලා මට පේන්නේ නැත්තේ. Okay, අපි එහෙනම් මේක කරලා අපි ඉවර කරමු. Anyway, I will do this projection. Okay, medical warrant. Sales 1 million. Cost of goods sold 600,000. GP 400,000. Administrative expenses 100,000. Selling expenses 50,000. Financial expenses 10,000. Net profit 140,000. Okay, percentage is still okay. Make 100%, 60%, 40%, 10%, 5%, 1%, 24%. Okay. Right, ඊළඟ ස්ටෙප් එක අපි යන් මේ ටික කැල්කියුලේට් කරන්න. Stock. In net recording days, stock intake 60,000. Cost of goods sold 600,000. Into 365 days. We have a calendar. $36.5 days. Data collection period 8,000. Sales 1 million. To 365 days. So since you don't have the credit sales, you take the total sales. 80,000 divided by 1 million into 365 days. 29.4 days. interest payment period 50,000. 50,000 divided by cost of goods sold into 365 days. $30. Divide 4. We have a cash cycle 36.5 plus 29.2 plus 36.5 plus 29.2 minus 30.5 is 10.1 day. 10 days, 10 times. Sorry, 55 days. $55.3 days. Cash cycle 365 divided by 35.3 is equal to 365 divided by 35.3 is equal to 10.33. Okay. Now we have calculated the cash cycle and ratios have been applied. Now the decision, how much of business the customer wanted, for temporarily, we assume that 300,000 what customer asked for us will allow for the rate of 18% per annum interest. So you are going to invest 300,000 in the cost of goods sold. So the 300,000 when you invest in the cost of goods sold, right? We're going to say, for example, January, 1st of January. At the end of December, what would be the aggregated cost of goods sold figure? Right? Now it is revolving 10 times. Whatever invested in the business is revolving 10 times. Last time we worked on that. So we work out here, find out how much. If you invested 300,000, if you invested 300,000, end of the year, it will increase by 10.33 times. That means when I include 2.23 million, and his cost of goods sold will be, right? Cost of goods sold will be this amount investment. What are you talking about? 3 million, 300,000 we are investing, plus what is the outstanding? The carry forward balance is 60. Last year carry forward balance 60,000. No, you can done it. So 360,000 will be invested in January, and it will be multiplied by 10.33. 360,000 into 10.33 times. That is 3 million. Investment will be 3 million 718,800. So the cost of goods sold, therefore, 3,718,800. If we invest 300,000 in a business plus carry forward balance of 60,000, it will come to 360,000. It will rotate in the business 10 times, generate profit 10 times, and therefore the accumulated figure will be 3.7 million 18,000. Then what will be the sales? Now this is 60, right? This is divided by 60 into 100. Sales will be 6,198,000. This is 60%. This is 100%. And 40% will be 2,479,200. Okay, administrative expenses 10% of the sales, that's 6,600 190. 600, 800. 5% is half of this, right? 10% of this 6190. Sorry, plus 50,000 extra expenses. Sorry, not 50,000. Plus on the interest rate 18% per annum for 30,000. 300,000 loan 18% per annum. Here 54,000. That's 54,000. $61,108 plus 54. 115,000. Profits of 1 million. Profit of 1,433,520 can be earned in this business. Investment of 300,000. 10% really, expenses very low. Increase by 10%. Take 500,000. Make it up 10% only very low. Right. So, what will be the solution? Well, now, what is your decision? Are you agreed to give this 300,000 to this customer? Are you agreed to give this 300,000 to the customer? My opinion is not to give this 300,000. Reason is we are over financing. The customer's capacity, see, he have earned 24,000 or 24% profit, 24,000 profit by investing only 60,000. That means 60,000 divided by 300, that cycle only 6,000. That means 60,000, sorry. 60,000, invested 60,000 in this inventory, he had generated income of 24,000 for the year. So therefore, if the capacity is there, we can go it. To expand such a large manner. It's very important to understand the investment in the customer. If a customer asks for some money, we have to work out and see actually what would be the projected finance, the figures, and find out whether it is productive or not, viable or not. According to my evaluation, I am not giving this facility. Why? It is overcapacity. Sometimes he may need about 50,000, could be okay. Not 300,000. If you have 50,000, you just work it out and see that will be customer can bear that expansion. Now here, the expansion is very large. I don't think he can bear it in such a big amount. Right? From profit 240,000 to increase to 1.7 million means within a year, that is high capacity. So it's not going to justify that lending. Therefore, it is we can calculate the amount customer needed, how much he need actually. By working out this type of method, we can come to conclusion decisions. So it is not the lending is not what customer giving what customer want asking. Lending is not customer asking. We have to work out and see how much customer want. Identify his need and try to give that facility. Then both the parties will survive. Now, if you are given this to the customer, what will happen? Within 1 month, he can pay back the loan. Not for 3 years. Within 1 month, he can pay back the loan. Okay. So, I think we did discuss the financial projection of financial statements, balance sheet and the P&L, how to calculate the balance sheet and the P&L for future period, and what are the basics, principles we apply. Different methods of, we discussed 3 methods, horizontal method, vertical method, and the ratio analysis method, and next the strategic method we discussed. Okay. So any question, anything there, you can jot down and we can discuss that problem. But if you are not understood, try to help you, because since we are far away, we can't see you, and we are not. I can't see your faces and whether you are actively involved or not. So let's see with this new system how the best we can help you to come across, learn this, study this important subject, the credit analysis part. Okay, so Thank you very much. We'll meet next week with another set of important financial tools to make credit decisions. Okay. Thank you. Goodbye.